In today's episode, we have a guest from Dimensional Fund Advisors, Evan's with us. A quick note about Dimensional Fund Advisors. They are one of the best in the industry. They are famous for the scientific pursuit of higher expected returns. I'm going to let Evan dive deeper into that. But Evan, is there anything you want to say about yourself?
Yeah, thanks, Thomas. Super excited to be here today. Just quickly about myself, I'm a regional director at Dimensional Fund Advisors. I'm currently located in our Charlotte, North Carolina office. But I've been at the firm for about 7.5 years now. I actually started in 2016 in our Austin, Texas office, which is our world headquarters. And after about a year and a half, got tapped on the shoulder for an opportunity on the East Coast, and I took it. So super excited to be here today. I'm glad to work with you and happy to talk about the scientific approach to investing.
Yeah, thank you. And again, this podcast is really catered around like how can this information help those who are listening to it, and that's why I thought you'd be a great guest, because if somebody is invested, whenever I see somebody in dimensional funds, Vanguard funds, I'm thinking, okay, they're already winning the investment game, so to say, that low cost, globally diversified. And I know a lot of times you get lumped into kind of that Vanguard VFA, but there is a clear difference between Vanguard and DFA. Could you talk to that for a little bit?
Yeah, absolutely. And it's super interesting if I just take a step back and just talk a little bit about the fund landscape and maybe the history of how Dimensional started. But David Booth, who is the founder of Dimensional, he was actually on a team at Wells Fargo that created the first ever index fund. So I just like to throw in that little bit of history just to show, hey, we have ties to indexing. That's actually where kind of the birthplace of Dimensional started. And we do view indexing as a good approach, right? It's a broadly diversified way for your clients to invest, and we know that broad diversification is extremely important. And then the other thing that we like about indexing is, or a Vanguard approach, is that it's low cost, and we know that costs matter, explicit and implicit, and if you can control that, you're going to put the odds of success of winning that proverbial money game in your favor. Now, what we do differently at Dimensional is we also incorporate academic research. So we take what we like about an indexing approach, or what Vanguard does, which is low cost and, of course, diversification. But then we add in the third component there, which is academic research and that scientific approach to investing. And that's where we're able to actually improve upon the returns of an index fund and even increase the odds of success for clients even further.
Yeah, I love that. Could you tell us a little bit more about that scientific approach, and what are some of the, when we say evidence-based investing, what are some of those tilts that that academic research has proven to lead to higher expected returns?
That's a great question, and I think it's good to progress towards those tilts, but first starting off at, let's call it a 30,000-foot view. We believe that markets work, and that market prices are fair. And what I mean by that is, on average, Thomas, there are $700 billion, a little less than $700 billion traded in stock markets each and every single trading day of the year, which is about 252 days a year. That's a lot of information that's being pumped into every individual security each and every single day. So when we say stock prices are fair, we're not necessarily saying that they're exactly correct, but we're saying that's the wisdom of the crowd speaking. The wisdom of the crowds is much more knowledgeable than any one individual investor. So across every single stock portfolio that we have here at Dimensional, across every single bond portfolio that we have here at Dimensional, we're always starting off with market prices. And that's kind of the first lens into how we use academic research at Dimensional. Now, you mentioned tilts, premiums is how some people talk about it. Some folks will call it smart beta. I think when I first started at Dimensional, we were pretty keen on calling it premiums, but they got so popular and there's so many names out there that we've kind of said, all right, you guys call it what you want. We're going to still call it premiums. But from a securities price, you can identify certain characteristics that are associated with higher expected returns. And those characteristics are not characteristics that Dimensional invented or created. This is These are characteristics that are proven in decades of academic theory and then empirical evidence that back up that academic theory. And that is key. There are so many investment managers out there that have research departments that are trying to time the market or find mispricings in securities. And then there's those investment managers, like you said, an indexer that's just trying to track the market. We're using the academic theory and the empirical evidence to position our portfolios. So it started off in the 70s. There was research by a gentleman. His name was Rolf Bonds. And the research showed that smaller companies had higher returns or higher expected returns than a larger company. And that intuitively makes sense, Thomas. If I were to come into your office right now and ask you for a loan for a business idea, and then 10 minutes later, Bill Gates walks into your office and asks for the exact same loan for the exact same business idea, you're going to require a higher rate of return from me. I'm the smaller of the two there.
So just for clarification, it may be close, but in case anyone was, yeah, got okay.
Just for clarification. And then value. So value stocks have higher expected returns than growth stocks. And the way I like to think about this, Thomas, is I'm sure you've traveled with your wife and with your family, and you've probably gone to a few Airbnbs throughout your life. Now imagine there's two Airbnbs in the same townhome community, exact same square footage, exact same townhome community, exact same city. But one's renting at $200 a night and the other's renting at $225 a night. Why on earth would you choose the $225 a night when you could save 25 bucks, 75 bucks for the weekend and go with the cheaper of the two? So relative to price or relative to expected future cash flows, stocks with lower prices, value stocks, have higher expected returns and growth. So that's small, value, and then the last one is profitability, which is the newest. 2012, the work of Robert Novi marks that firms that are more profitable are associated with higher expected returns than firms that are less profitable. And those are the three premiums factors that we incorporate in our equity or our stock portfolios.
Yeah, thank you for diving deep into that. I think that is helpful. And again, there's so much future uncertainty. It's so hard to accurately predict like what will happen. And so then we have to go off the next best thing. Well, what would we expect to happen? Mm-hmm. And I think that's where Dimensional comes in and just does an amazing job. In fact, a story comes to mind a couple of years ago as Tesla was raising in value very quickly. Like they were becoming miscategorized in different index funds, right? The mid cap, large cap. And I remember a story from Dimensional about how they were like, this was one of the clear differences of Dimensional to a standard index fund, was that they were able, as soon as it had kind of moved away from that category, you guys were able to act on that quickly instead of having to wait for a set date and time where you guys can then, update it whenever every other index fund is updating. Can you talk a little bit about that flexibility that you guys have there?
Absolutely. And it really goes back to the indexing approach and that traditional stock picking approach, how we can improve upon that in terms of our flexibility, or we would just say as an umbrella term, implementation. Unlike an index fund, we're not tied to any rebalance dates. So for the listeners out there, index funds will rebalance or change their holdings once, twice, maybe 4 times a year, but that's really as good as it gets. And then active managers, they're trying to time the market. They're trying to find mispricings in securities. So they could be flexible, but if you think you know more than everybody else, you want to act on that as soon as possible. Because we're not tied to an index and because we're not trying to time the market, we're able to be flexible in trading every single day of the year. So in the case of Tesla, the other one that comes to mind is GameStop and AMC. When you have a stock that has that meteoric rise and moves from one category in the market to another category in the market, we have the ability to make that adjustment in our portfolio immediately. And the analogy or the example that I like to give is if you get your hair cut once or twice a year, you're going to look very different throughout the year. You'll have short hair. Then right before you get your haircut, you're going to have really long hair. What we're doing at Dimensional is we're saying, hey, let's get a regular haircut. Let's do it once a week for the example of a haircut, but in reality, our portfolios every single trading day, and make sure that we're keeping the portfolios pure to the exposure of their asset class the way that they're supposed to be.
Yeah. I love this. And again, this podcast isn't meant to be investment advice, just general education. But along those lines of general education, the odds are in your favor when you do pick a low-cost, globally diversified portfolio instead of, and thinking of time in the market instead of timing the market, everything that you said. And I've showed before on a different YouTube video, Spiva, where they've tracked, all active managers over 10, 15 years, how many of them actually outperform the market, and it's a very small percentage of them, which goes to show it is a hard thing to do. I know Dimensional has a really good track record because they basically are mimicking the low-cost, globally diversified index, but then just building into that those three premiums that you talked about, right? Size, value, and profitability. And that's where you would expect over long periods of time high returns. Now, it doesn't always work like that. And in fact, maybe this is good to go back to the start of Dimensional. Your day-to-day investor could only access Dimensional funds through an advisor. And I think the thought behind that was Dimensional wanted the financial planning paired with this, the long-term focus. Can you talk more about that?
Absolutely. When we started in 1981, we actually did not work with financial advisors. We only worked with institutions. So we only worked with large companies, sovereign wealth funds, big endowments, for example, big institutions. And really the idea is, hey, we have this approach of not trying to time the market, not trying to outguess the market, but with the academic research on our side, outperform the market. And in order to put the odds in your favor of having that successful investment experience, you can't be going in and out of our portfolios. Ends up being taxable consequences oftentimes to other shareholders. And that's why we started working out with specifically institutional investors. Now, in the 90s, a man of the name of Dan Wheeler, I believe at the time he was an advisor not using Dimensional, but he heard about our approach, fell in love with it, and he approached David Booth, our founder, and said, hey, I have an idea. Let's create this awesome educational experience for advisors that want to use Dimensional. We'll explain to them how we think about markets, why having a buy and hold approach, time in the market versus time out of the market, is so important. And then we could start working with financial advisors. So that started in, I believe, 91. Fast forward to present day, most of our assets, the Dimensional assets, are actually now in the hands of financial advisors. So we've always worked with institutions and financial advisors. Historically, on the mutual fund side, we never worked with a retail investor, and that actually lends itself more to the value of advice. Financial advisors like yourself, Thomas, we truly believe that you guys add so much value of putting the odds in investors' favors for success. So we're always trying to work and advocate for a partnership with a financial advisor.
Yeah, and I think a big part of that value is, again, another topic I've covered in a prior YouTube video, is what they call the behavior gap, where advisors are really good at helping clients manage the behavior gap. And in a nutshell, that behavior gap is when markets are up and you're hearing your brother-in-law tell all these stories of all their wins. Well, then you get greedy and then you want to buy in when the market's high. But then when the market goes down and everything on the news seems gloomy and uncertain, then you get scared and then you want to sell. So then you're buying high and you're selling low. And if you do that enough times, you run out of money, right? And Warren Buffett said do the opposite. He said be fearful when others are greedy, and be greedy when others are fearful, aka buy low, sell high. And so advisors are really good at helping people navigate the behavior gap, and Vanguard's even done research on that and have quantified the value of that to almost 3%.
Absolutely.
I appreciate that. But even recently, this is kind of exciting, is the involvement of Dimensional Fund Advisors, where they've now incorporated ETFs in their strategy, which are just slightly more tax efficient than a mutual fund. Can you talk a little bit about that?
Yes, I will. 1 second, though. I want to, the analogy I love about the behavior gap is your portfolio is like a bar of soap. The more you use it, the trading in, getting out, the less you have. And just personally, I've worked at Dimensional through 2020. The market was down, 30% in March. And then we finished, I think, 18% up at the end of that year. I mean, talk about missing an awesome opportunity just to stay in your seat and get an incredible return. And then the next was 2022, which was one of I think it was the third worst 60-40, so 60% stocks, 40% bond portfolio years ever. And then sure enough, 2023, 2024, both great years. So I completely agree with what you said.
That is a good point, and maybe we can, before we dive into the ETFs, 2022 was an interesting year, right? Because even on the fixed income side, the bond side of the portfolio, where interest rates were nothing and they quickly rose, where that was a stressful year.
Yeah.
For people who were in that capital preservation mindset, right? Because their stocks and bond portfolios were down. And sometimes that happens. Like 2022 wasn't the only year that happens. And that's why a follow-up podcast I'll have is with Asset Dedication, who is an investment manager who uses dimensional funds for the equity. And then on the fixed income side, they build these bond ladders, right? So the liability immunization, that way, you can buy and hold and know exactly what to expect. And just psychologically, again, back to the behavior gap, I think that can help you stay in the market when you know, hey, I have time for the stocks to recover because my short-term cash flow needs are in cash, or in a bond ladder that's going to mature, and I know exactly what to expect. This is getting a little nerdier in the weeds for those listening, but ETFs are slightly more tax efficient than mutual funds, and so for DFA to offer everything that they're doing now inside of an ETF wrapper is a big deal. It's pretty cool. So could you talk a little bit about that?
Yeah, absolutely. And ETFs have been around for a long time, and we really entered the ETF space in 2020. The reason why we waited, and it goes back to the flexibility that you mentioned before 2019, we could not flexibly trade in and out of an ETF, meaning we would have to buy a basket of securities, and once, twice, maybe 4 times a year, we'd be able to rebalance it, but we wouldn't be able to update it 252 trading days throughout the year. So that was really our reason why we said, hey, we're going to continue launching mutual funds and not step into the ETF space. In 2019, the SEC created a rule called, interestingly, the rule, which allowed us, for lack of better terms, so creative, the government, right? We can now flexibly trade in and out of our ETFs. So as soon as that rule passed, we hit the ground running. We said, how do we offer what we're doing in our mutual fund space in an ETF space? Fast forward to today, I think we probably have nearly or above 40-ish ETFs across most markets, across most asset classes meaning a specific section of the market. We are the largest active ETF manager in the country. And I believe the last 2 years, we still have to wait until the end of this year, but the last 2 years, we were number 1 in terms of net new assets into the ETF space. So we've really jumped on in and made a huge presence. Part of the reason why advisors like ETFs, and again, we're agnostic to a mutual fund or ETF, but one reason why an advisor might like an ETF is because they do have a tax efficient mechanism that maybe expands beyond a traditional mutual fund. And if you remember earlier in this podcast, I mentioned if you have hot money, or not even hot money, just a big redemption coming out of a mutual fund, we have to sell securities, and that could create a capital gain distribution for the rest of the shareholders in the portfolio. In an ETF, we don't have to sell. Instead of selling securities, we can just, for lack of better words, trade securities we want out and then get other securities we want in. And that is defined as an in-kind trade, not a sale. And because that's an in-kind trade, there's no taxable consequence. It just gets deferred until the investor eventually sells their ETF shares 10, 20 years down the road. So summarizing all of that, ETFs are slightly more tax efficient because they're preventing long-term capital gains distributions at the end of each year.
Yeah, that was a beautiful explanation. Evan, you simplified that wonderfully. You're definitely a smart man, and Dimensional's lucky to have you. I am curious, let's see, is there anything that I missed and you're actually teaching me, I forgot that the start of Dimensional was with institutions and not even advisors. So I came in a little bit late to that history. But is there anything else about the history of Dimensional that you think would be helpful for listeners to know?
Absolutely. Have you ever read the book Outliers?
Yes, Malcolm Gladwell, great book.
Yeah, there's a good chapter in there, a couple pages in there that talk about Bill Gates and how he lived near one of the first supercomputers. I think it was in the 60s. And it really just talks about how this big bang happened in computing technology in the 60s. That exact time period, the computing big bang, for lack of better words, is very relevant in the investment space. And what I mean by that is before there were computers, it was all stock pickers. So we know that the data is overwhelmingly against a stock picker from outperforming, but that was the only way that you could invest in the market back then. Once the computer industry took off and we were able to synthesize data, large amounts of data, we were able to say, okay, let's take a look at all of those active managers and let's see how they actually performed. Did they beat, let's call it, the market or the first ever index that was created? And then, of course, they found that those returns were pretty suboptimal relative to just holding the market. So I think that's a pretty cool piece of history that really lent itself to the birth of dimensional and the birth of indexing. And the reason why is so David Booth, who founded Dimensional in 1981, before Dimensional, he worked at Wells Fargo with a man named Mac McCown, who actually passed away, sadly, about a month ago. The founder of Dimensional created the first ever index fund for institutional investors. And after that, that really lent him to saying, okay, let's take this a bit further and start incorporating some of this academic research that's coming out.
Yeah, that it's pretty. And in fact, there's even a movie called Tune Out the Noise that goes into this deeper. It's a really good movie. Is that publicly available?
I believe so. I believe it's on dimensional.com, but I would have to follow up. Maybe we can put that in the show notes or something like that.
Okay. Yeah, I'm sure. Yeah, if anyone wants to see the evolution of Dimensional and kind of, I think it is insightful. It's a well done movie for sure. So with that, what does Dimensional look like today? We've talked that it has ties to academia. Is there anything that you want to highlight that, and specifically through the lens too, like how will knowing this help the people that are listening to this podcast? What would you want them to know about Dimensional today?
Yeah, I think the main thing that I would want them to know about Dimensional today in terms of putting the odds of success for a good investment experience in their favor, it's less about Dimensional. It's more about our one investment philosophy. And I hit on that at the beginning. But it is so important to, quote unquote, tune out the noise, which is the name of that film that you mentioned. There is so much noise in the universe right now, geopolitical issues, challenges within the United States, the economy, the president. It really all just boils down to there are so many factors that go into the stock market and bond market returns. It's so easy to just focus on one and say, because this person did or did not get elected, or because the economy did this and not did that, the market's going to be doomed. And it's just not the truth. And time again, when we see this, the folks that just tune out the noise, don't vote with their portfolios, but vote with their ballots, are the ones that are the most successful. And that's something that we absolutely preach at Dimensional.
And really, any money that is in stock should be long-term money, right? If this is short-term money that you need for groceries, like it shouldn't be invested in the stock market.
Exactly.
So if you have the long-term focus, then yeah, tuning out the noise. I think Dimensional does a great job of that and helping remind us. Now, how does this set you apart from all the other fund managers? And maybe going. Yeah, maybe we'll just start there. So your ties to academia, everything, your focus for today for investors, tuning out the noise, how does this set you apart?
Absolutely. Since the firm was founded in 1981, we've had ties to academia. And I think that's important to note. So David Booth, the founder of Dimensional, he was actually a graduate student, an assistant under Eugene Fama. And Eugene Fama, if any of your listeners have taken finance courses in their studies, Eugene Fama has been coined the term the father of modern finance. So I like to start there because that kind of also is timely with the start of Dimensional. But there are many other big academic scientists within the financial landscape that are affiliated with Dimensional since the beginning. Ken French. So Ken French and Eugene Fama, they created the three-factor model, which is small value and actually equities outperform T-bills. That's the third factor. Merton Miller, the late Merton Miller, he was involved with Dimensional from 1981 to the start. And then there's so many more throughout the years. The kind of the proof in the pudding is that we have 5 academics that have worked with us that have gotten their Nobel Prize or their Nobel laureates. 4 of them.
Only 5? Oh man, that's
Only 5.
Yeah,
Yeah.
I mean,
Maybe I'll be next.
I'm a one-man shop. No, I'm just kidding. That's incredible. I remember talking to somebody who had just got a job at Dimensional, and when they were like, "Holy cow, I just ate lunch with Eugene Fama," they were like,
Yep.
like fanboying. It was really cool. That I think that absolutely sets you apart to have people who have won Nobel Prizes in finance and economics influencing and shaping the company. That's incredible.
Yeah, and I think the joke inside the office, not really in the Charlotte office, more so in the Austin office because that's the headquarters. Ken French really likes the strawberry ice cream in our cafe. I was there for, like I said, about a year and a half. I probably saw him 5 to 6 times. So strong ties. And of those 5 Nobel laureates, 4 of them got it after they started working at Dimensional. So we didn't do the research. I mean, it's their own research. But the point is that we identified these leaders in financial science very early on in the birth of Dimensional. And a lot of them still consult or are members of the independent board of directors with Dimensional today. So very, very strong ties to Dimensional. I have to mention, though, that their work is all public. So really any investment manager can go out and take their work and implement it. What sets us apart is our own internal research team at Dimensional. So that's employees of Dimensional comprised of PhDs, senior researchers that are taking the academic research and then putting it into practice in our portfolios.
Yeah, and I think this is an important takeaway. So again, kind of back to those SPIVA results that, hey, even full-time professionals whose entire job is to outperform the market, a substantial portion of them do not do that. And so then when you think, okay, where we believe markets are efficient, information so widespread, like, do you really think that you can, day trade your way to outperform the companies that have way more resources than you and analysts? And it's like, can it happen? Sure, right? I think that there were a lot of people, you mentioned GameStop and AMC. I think some people got extremely lucky with that. But then the problem was then they confused the luck for skill, and then they tried to duplicate it, and then a lot of people who made a lot of money ended up losing a lot of money. And so it's just interesting. I do think that is a helpful note. So again, how can this help you win the money game? Low cost, globally diversified, hold for the long term with your long-term money. Have your short-term money not in a long-term investment. I think those are takeaways that can be really, really helpful just for the day-to-day American. Could you just spend a minute, differentiate the difference between Dimensional and compare and contrast what people would call an active fund versus a passive index fund?
Yeah, absolutely. So I've alluded to this a little bit, but traditional active managers, and I say traditional because I would lean to say that Dimensional is more active than quote unquote a passive manager. A traditional active manager, their one goal is to outguess the market and outperform it. We would agree. We want to outperform the market too. We just think that we can outperform it without having to outguess it. So Thomas, you hit on this a little bit. Traditionally, those active managers, their portfolios are more concentrated, meaning they hold a smaller number of stocks because they only want to hold the winners in their eyes. Their portfolios tend to have a lot of turnover. Turnover meaning, hey, this was a really good idea last week. I have a new idea this week. Let's sell those old securities. Let's buy these new securities. And then lastly, because of all that and because they're paying their equity researchers so much money because they know so much that everyone else doesn't know, their fees are really high. Their expense ratios are really high. And what we see in the data is that all of those turnover and fees, the higher the turnover and the higher the expense ratios, the number of active funds underperform. It increases. So that's why we don't pursue market returns, or we don't pursue our portfolio design like a traditional active manager. What we're doing differently than them is we're broadly diversified. We don't have concentrated portfolios. We're putting the odds of success in your favor. We don't know what stock's going to outperform, but we can increase the odds by holding the entire market. We have very low turnover. Our core funds, our total market solutions, on average have about a 5% turnover. The back of the napkin math there is 100 divided by 5 is equal to 20. The average security in our core funds is in the portfolio for 20 years. So compare and contrast that to the example I used before. And then lastly, our fees are really low. We're not as low as a traditional index fund, but we're in the bottom decile, at least the bottom quartile for each asset class. And just a note there, low fees are great, but you don't necessarily want the lowest fee, right? Like you don't go buy your sushi from 7-Eleven. There's probably a happy medium there, and our results definitely show that net of fees, we're able to outperform a traditional index fund.
Yeah, I do think. I do think in general, low fees is good, solid. I want to say advice, but again, this podcast isn't advice. Low cost, controlling costs, that is something in your control, right? Taxation, costs, those are things you can control. If you can minimize those, then that's less drag on your portfolio over long periods of time. Yeah. So in general, it's lower fees is a good thing. However, you are right that you really have to be thinking net of fees. In fact, what people want to maximize, they don't even want to maximize their returns. They want to maximize their after-tax spendable dollar. Like that's what they really care about, is converting this into something they actually care about, like going on vacation or spending time with family or hobbies. And so I do think that is helpful, a helpful analogy or comparison, that it really does come down to how can we help you maximize your after-tax spendable dollar, and that's what we're trying to go for. So thank you for making that. Yeah, it is.
And just a note. Oh, sorry, I didn't mean to interrupt there.
Well, I wish more people would think that way as well. That it's like cost is only one factor consideration, but there is, what are you getting for that? Like, what is the value in that? Because even like same thing as an advisor. Like, there's a cost of working with an advisor, but what is the value of working with an advisor?
Yeah, well, and we're a big asset manager, and we see the value in it. If an individual investor goes to our website and clicks the tab that says invest, first thing that comes up is a portal to put in their zip code to offer up an advisor, because we believe in the partnership an advisor has with an individual investor. You have a doctor. Some people have fitness trainers. Some people have coaches for their careers. Why stop at your life savings? It's such an important deal, especially if your life is really busy and you're entering your retiring years and you just want to enjoy and you don't want to have to worry about withdrawals and things like that. Hire a professional to do that for you.
The older I get and wiser I get, the more I am a fan of delegation and net value. If there's something I can do to pay someone else that can do it better than me and save me time so I can focus on what's important to me, that is a trade I'll make 10 out of 10 times. That's awesome. That's wonderful. I know we talked a little bit about the nuance. What I thought was interesting about dimensional fund, how you comparing and contrast index fund, active manager. We talked about the Tesla, AMC, GameStop example, where you can be nimble as things are categorizing. Or recategorizing, I should say. Let's see. What about asset allocation? Could you give us the 30,000-foot view of Dimensional's view on asset allocation?
Yeah, absolutely. And I do think asset allocation tends to be more customized depending on what the client's or the investor's goals are. But in general, we have wealth models. And the way that we think about it is, again, from a fund selection point, diversification, low costs, academic research, financial science or academic research. But from there, it really depends on your risk profile, right? So I'm younger, you're younger, we have a long time horizon. So at the highest level, we probably want to have more stocks and less bonds. Why do I say that? Stocks tend to have higher expected returns. Bonds tend to have lower expected returns relative to an individual stock. But as we get closer to liabilities in our future, like retirement, maybe it's buying that forever home, maybe it's children's colleges, that's where you want to look at your asset allocation and say, okay, maybe now it's time to dial back some of that stock exposure. We've done well for the last 15 years. Let's trim it back and put more into bonds because we want to have stability. We want to have a ballast in the portfolio. So it's really marrying the goals of the investor, the individual, and then the risk tolerance of the investor, and then their portfolio's equity and fixed income split.
What are some of the risks that you think investors should be thinking about as they're building, constructing their portfolios?
You know, the one that I've been hearing a lot about, and we mentioned this at the beginning, 2022 was a really tough year for bonds. Bonds themselves, it was the worst bond year ever. And for folks that are getting near a liability, let's just use retirement because it's the biggest liability that people will have in their lifetime. They didn't realize that a bond that's longer term, let's call it 5-6 years, if interest rates rise, all else equal, the value of that's going to go down. And they needed that money. They needed that money in the next year or the next 2 years. So the general rule of thumb is that however far out your liability is, you want to make sure the duration, or in other words, the term of your bond portfolio, how long it is less than that liability. Because if interest rates were to go up and the value of your account goes down, you're now compounding at much higher rates and you're going to be much, much more better off. If the duration of that portfolio, or again, let's just call it term, length of time, is longer than that liability, you might not have enough time to catch up. So that's been one that I've seen recently, just spanning from that 2022 time period.
Yeah. And that's where we get into I think that liability immunization is really helpful, meaning locking in these maturities for when you need the cash, so that way even if interest rates move, it's not impacting you because you're not selling the bond, you're holding it to duration. That is a risk to consider. Let me ask you this: how many funds do you think an investor should use?
Yeah, that's a great question. There was a piece of psychological literature that was passed around my desk, I want to say 4 or 5 years ago, that talked about the psychology of menus when you go to a restaurant, and how restaurant goers, diners, are better off, have a better experience when there's like 5 or 6 items on the menu versus your typical Cheesecake Factory where you've got the entire supermarket on the menu.
Yeah, I recently ate at Cheesecake Factory, and it was almost too big of a menu for me. I was like, I literally just had to ask the waiter, just, what are you most known for? What is your most popular dish? Can I try that? Like, it was too overwhelming.
Yeah, and they put the calories on the menu, which always is a burden for sure. But I think that applies to building a portfolio too. So you could buy a total market solution. So when I say total market, I mean you are owning every single stock in the United States, 3,000 give or take stocks. You can buy that for the US, you can buy that for international developed countries, you can buy that for emerging market countries. That is 3 holdings that is giving you access to 15,000 stocks across the world. I mean, talk about diversification. I think that is incredible. So my point in saying that is you really don't need a lot of holdings in your portfolio to get access to broad diversification and, of course, that academic research that we talked about before. Yeah. Now, some people do like to have more specific allocations, and that's totally fine too. There's no right or wrong answer, but don't confuse number of holdings with a chance to outperform or something like that.
Yeah. Yeah, and sometimes here's where maybe this is helpful. Again, thinking of whoever's listening to this podcast, how can this help you win the money game? Part of my career of being an advisor, I've helped navigate many corporate retirement plans. And so
Yeah.
inside a corporate retirement plan, typically the default investment option is a target date fund, which
Yeah.
is actually it's a really good starting point for a default
Yeah.
option where if you don't do anything, then you know when you're younger, it's going to be more aggressive. And as you get closer to retirement, it's going to become more conservative.
Yeah.
But what I see a few mistakes, right? I see, well, what I would consider a mistake. I would see some people who may start mixing in a bunch of different funds. They'll have the target date fund and then all these other funds. I'm like, well, you're kind of like lessening the impact of the target date fund of how it's supposed to
Yeah.
work for you. So it really should be like that could be your one fund in your 401k. Or
Yeah.
you could be more, like you said, strategic or tactical in these different spots. And I do think, especially once you start getting money in other accounts, and now we can think about asset location. So which types of investments are in which accounts, and how can we maximize, again, that after-tax spendable dollar? Because the taxation of these investments are different, right? Where you have bonds that are kicking off ordinary interest, and you have stocks that maybe you're getting a qualified dividend and long-term capital gains treatment on that. So it's like, okay, well, if we know that, like, let's put tax inefficient assets in tax efficient account. And so that's where, like, okay, now a target date fund maybe doesn't make sense because a target date fund mixes stocks and bonds into one fund where we can be more tactical about that. But as a starting point, I think it is still a good starting point until you get to a stage in life where you have more complexity. And then I think that's where the value of an advisor is to help you determine that. So
Yeah, to your point on the fund zoo, for lack of better words, I part of my job is analyzing a lot of portfolios, and I can't tell you how many times an advisor will win a new prospect that'll become a client for that advisor, and that advisor will send me their current asset allocation, and it's got all of these expensive, concentrated, traditional active funds. Let's call it 10 to 20. And what I do is I plot them on a characteristics chart, which basically just says, in aggregate, what does your portfolio look like? Is it tilted towards small cap value? Is it tilted towards large cap growth? The amount of times that it plots right in the middle, which is the market, is crazy. And they could just save money on fees, simplify their entire investment portfolio, and simplify, give themselves peace of mind just by holding a total market solution. So I find that fascinating.
yeah, that is. There's probably some psychology there where people feel like they need to have different funds, and really probably what it is that the education gap, right? Because even some people will think like, hey, if I own 3 different accounts that all hold the same fund, but if they're at different places, Vanguard, Schwab, Fidelity, then that feels more diversified. And it's like, well, you're not really investing into Vanguard, Fidelity, or Schwab.
Yeah.
They're just holding the assets. So actually, to your point, a lot of times we can come in and help somebody simplify what they have going on. A lot of times, bring down their fees, add a lot of value, and that peace of mind. So that's a great point. I'm curious, is there anything else that you think would be helpful as we wrap up this podcast, that maybe common mistakes that you've seen that kind of like I mentioned the 401k where they may be deviating from how a target date fund is meant to work. Are there any other common mistakes or things that you see that could help your day-to-day investor?
Yeah, I think it just goes back to the general theme of a lot of the investment topics that we discussed today. It's you have to have a long-term approach. You have to know what you're doing, and you have to tune out the noise, because there is no investment strategy. There is no investment strategy that can guarantee you any type of return over any single type of time period. It's just not possible. So there are always going to be periods where you underperform, and there'll be periods where you outperform. But if you have an investment philosophy that you can stick with through all of those periods, you are putting an incredible amount of odds in your favor for having a successful investment experience.
So, Evan, if somebody wanted to go and learn more about Dimensional, about your investment philosophy, where's a good place to point them?
Yeah, so our website, I believe it's us.dimensional.com or it's dimensional.com. I could send that, but we revamped the website a couple years ago or even sooner. It's incredible. A lot of the stuff that Thomas and I talked about today is on there, and would love for folks to check that out.
But yeah, Evan, thank you for your time. I thought that was helpful. That's interesting, and I really hope those that are listening to this can take that away. Again, stick to your investment philosophy. Keep costs low. Time in the market, not timing the market. Tying the scientific pursuit, the academic overlay to your investment philosophy without knowing the future, what would you expect, going forward? So these are all huge wins in the investment world. Oh, sorry. Now I know what I was going to say. Yeah, there's no guarantee. Maybe this is good to end with as well. Like Evan said, there really isn't this silver bullet, magical investment that you can depend on, right? These guaranteed returns. And so if anyone's ever selling you something that sounds too good to be true, it probably is too good to be true. And so I think it's good to have your guards up, or maybe get a second opinion if you ever hear of something that sounds tempting because it sounds too good to be true. Because unfortunately that is part of the noise that people have to navigate in when it comes to managing their personal portfolio. Awesome. Well, Evan, thanks again, and we'll talk soon.